Hey everybody, it's Eduardo with the Pirate Team. I wanted to send out a quick video providing a summary of a great article by Ryan Lundquist, who's a local appraiser, and there's a link included in this email, or if you're watching this online, in the description below, that I highly recommend that you guys check out. Know that all the graphs that you see here are taken directly from his blog, and I just wanted to provide a quick summary for those of you that only have a few seconds to or a few minutes to check it out. And so I'm going to dive right in. If you have any more questions, feel free to reach out. Number's 916-215-4348, or hit me up via email at eduardo@thepireteam.com. All right, let's dive right in. So one of the things that we wanted to point out is with what the medium price is doing in the Sacramento area. And as you can see here, we have it for the general region, which is in this kind of darker green. We have it for Sacramento, which is kind of this lavender. Placer is the lighter green. El Dorado is the orange, and Yolo is gray. And so what we've seen overall, when you follow the market since 2014, you see that there was definitely a dip from 2014 to 2015. There was a bit of a leveling from 2015 to 2017. So we saw price growth, but it was fairly small and steady for those few years. And then in 2017, we saw the market dip back down again from 2017 up until 2019. But as you can see here, just within the region, we've seen this hockey stick type of rise in home prices just over the last year, which is something that we're still very much seeing today. And we'll go over how this impacts you as a seller and as a buyer in just a minute. So from here, the next, one of the things that we want to point out is that this isn't just a unique condition to Sacramento. We're kind of seeing this in metropolitan areas throughout the country. And so you can see here, everything from Atlanta, New York, Washington, D.C., Portland, Denver, and so on. You're seeing a similar type of a graph happen with the year over year change here in this case, right? So you saw fairly level and then a spike. You see some that were on decline and then a spike. You see some that were really high and then a severe drop and then a spike again. And so this is something that we're kind of seeing across the nation. And so we'd love to say that it was more unique to Sacramento, but it's not. The big piece that we really want to lift up, and this is both for buyers and sellers, and there's pluses and minuses for both, right? What we're seeing here is this is just looking at a year over year, or not year over year, but a 12-month kind of cycle, all the way from 2016 through 2021 to see where the year started and where it ended. And what you find is that there's typically a fairly common pattern that is followed or trajectory that's followed every year, where you see a rise from about January through the summer, and then you start to see a dip, and then you start to kind of see, in most cases, kind of a stabilization, if not a slight decline. You saw that in 2016, you saw that in 2017, a little bit more aggressive of a climb, and then a leveling out. Similar in 2018, similar in 2019. When we get to 2020, we see something completely different, right? So in 2020, we saw us, and you see that every single year, the year starts off at a higher point. In 2020, we started the year at about 415. It climbed up, and then in March, the pandemic hit, or the shutdowns hit at least, and so we saw this decline, right? And it was a lot of uncertainty, didn't know what was going to happen with folks. Folks were kind of concerned about jobs. And once the stimulus came through, and once people kind of had the chance to experience it and see that there was a light at the end of the tunnel for themselves, at least some security to kind of be able to weather the storm, you started to see things pick right back up, right? And so we've been on this upward trajectory now for 10 months of month over month growth. And so you see that starting really kind of in May, once things kind of mellowed out on the pandemic front with regard to the uncertainty, you started to see this jump in folks that were looking to buy and sell throughout the Sacramento area. And so you've seen this pretty steady increase in the home pricing for the remainder of the year, right? And so you see a slight dip, which you would have expected this to happen here in summer, right back here, but you see that it basically climbs through. And so we're essentially still somewhat in that cycle at the moment, to the point where you see that it started to kind of peak down a tiny bit at the end of the year, but come January, you see that the line is going upwards, and it's starting at $60,000 over where it started last year. So just think about that. I mean, that's a significant jump point, right? And so folks may be looking at this and saying, it's a bubble. It's going to pop at some point, right? And to looking at data from 2005, and again, these are all things to Ryan Lundquist. So as you can see, Sacramento Appraisal blog down here, definitely recommend you check out his article. So we have already surpassed the high price point from 2005, right? And so people are looking at that and saying, oh, bubble, right? What we want to point out is that each bubble that has impacted or that has occurred and had national kind of ramifications is a bit different. And so what you did see in 2005 is you saw the peak and then you saw a steep decline. And then it was basically from 2008 up until we started to see some steady climbing up in 20, about 2012, 2013, right? And then you start to kind of see that pretty steady climb back up. And so we're already at about 125,000. We're approaching over what the high price point for the median price was for the Sacramento area in 2020, in August of 2020. And so one of the things that people are pointing to as the bubble is the forbearance, right? And people are looking at that and saying, well, it's just a matter of time. As soon as those protections go out, you're gonna see a bunch of people that are no longer able to afford. In most cases, they're anticipating that folks that had rentals that have not been able to collect rent because of moratoriums on evictions and such, that those are the folks that are going to be all of a sudden flooding the market with those properties, and that's going to be what declines prices. The reality is, and this is taken from a recent Mortgage Bankers Association survey, that the amount of homes that are actually in forbearance nationwide is not as many as you might think. And there's actually been a slight decline in the number of folks that are actually still in forbearance, and a slightly uptick in the folks that are stepping out of forbearance. All that to say that this flood of homes that folks were hoping would come on the market, not to say that there won't be some, but it won't be the same level that we saw in 2008. And the reason for that is 2008, and what you're seeing in this particular graph, again, thank you to Ryan Lundquist for pulling this information together. These are the recession, this is what real estate and price cycles show, and the red lines are recessions, down market recessions that have impacted the national and global stage. And so here you see in 1980s, you saw a slight decrease, but you didn't see a significant drop in housing prices. You actually saw a leveling out, but then a fairly steady uptick up until the early 90s. In the early 90s, we saw another recession hit us, and you did see home prices start to climb down. But by the end of that decade, you start to see an uptick in pricing. All of a sudden, you see a significant jump, right, in the price index. All of a sudden in 2008, 2007, 2008, you do see this significant decline. What's different about this particular decline versus these particular declines is that this particular decline was housing driven. There's folks can argue about it, but the fact of the matter is that there were predatory lenders that were out there and getting folks into loans that they couldn't afford. And so when the balloon payment came up, or when the interest rate adjusted, it became unaffordable for many of these folks to be able to hold on to their homes. And so they were putting their homes on the market. For those that could have held on to them but saw the market decline, panicked, unfortunately, and decided that because they were all of a sudden seeing that the value of their home was worth less than what they owed, were letting it go to foreclosure, unfortunately. And so you saw all of a sudden banks take on all of these negative debts onto their books, and so flooded the market to get these off of their books to reliquify, and in so doing flooded the market to a point where the balance was on the buyer's side because there was so many options to purchase, right? And so that's why you saw prices driven down, because there was a lot more choice for buyers at that time. And then ever since the recovery that we've been experiencing since the mid 2010s, you start to see that it's been a pretty steady climb up. And so we say all this because for those that are anticipating that there will be a drop at some point, there's no doubt that at some point there will be an adjustment. There has to be, right? I would say, and following Ryan's lead, this is to a degree unsustainable to just continue to see this uptick. We're hoping, to be honest with you, even as a realtor, that there is a leveling out, because it is incredibly competitive to get into contract. I can tell you the last few contracts that I've written, we've written well over asking in order to be competitive. And the good thing to know is that in a couple of these contracts that I've successfully closed, and we'll be closing a couple this week, they were using down payment assistance. So I need folks to know that if you're not in that position to buy cash, which honestly, in another video, I'll show you guys what the breakdowns are looking like. It's still not a big part of the market. It sure has been fairly steady and slight uptick, but it's not that you're seeing this flood of cash buyers stepping into the Sacramento market that are eating up these properties. But so know that there is still hope. You do want to work with a real estate professional and a lender to know how to navigate these tumultuous times, to make sure that they're structuring both the deals and the finances for you in a way that puts you in a strong position to continue to grow and to weather any storms that are on the horizon. So take a look at the article. Like I mentioned, it's linked below. These are the price cycles. You see that it's very similar in Sacramento. And really, for those that are kind of anticipating when the market's going to go down, the question that I would ask for you is, how long are you willing to wait? Right? If you're thinking that the market is going to go down, if you're thinking it's going to bottom out in the next year or so, based on past trends, and that's all we can point to. I don't have any predictions for you. All I can offer up is data based on what's happened in the past. So when you look at how long did the down cycles last during past recessions or depressions, you see that in the 1980s, it lasted 9 months before the market picked back up. In the 1990s, it was 5.5 years before the market bottomed out and started to pick back up. In the 2000s, we saw another cycle of about five, almost 6 years before the market bottomed out and came back up. So for those of you that are waiting to see the market bottom out, the reality is that, let's say hypothetically, by the end of this year, 2021, something happens and the market does bottom out. Well, it does begin its decline. It could be something as short as 9 months, right? So that by near the end of 2022, we're picking back up, or it could be up until 2025, 2026, before you start to see the market truly bottom out to the place where folks are anticipating it's going to go based on their experience in 2008. But the reality is that is 6 years of rent. That is 6 years of, if you're in a home waiting to upgrade or downgrade, whatever you want to do, of that equity kind of going up and down with you. So I say that only to really help folks temper kind of what they're anticipating the market to do, because again, we don't have predictions. If I had a crystal ball, trust me, I would be calling every single one of my clients right now and family members, getting them ready. We don't. As best as we can tell based on the data and the low interest rates, which is really driving demand right now, we're still getting folks that are getting approved at 2.5%, even with down payment assistance. We're seeing at 3.25 for investment properties. My wife and I just refinanced recently at 2.85 for an investment property. Right. So interest rates right now are well worth you exploring. Would love to have a conversation for folks that are considering how to leverage equity in their home to make sure that you're putting yourself in the strongest position in alignment with your goals longer term. But in the meantime, take all this into account, and please just know, again, this is taken directly from Ryan's blog, which is linked below. It's tempting. It is super tempting to say 5.5, 5.6 years. All right. So let's just call it 6 years. In 6 years, 2027, that's when the market's going to bottom out. And I just got to be in a position in 6 years to do that. There, as he states here, there is no rule. It could be that it's that length of time. It could be that it's 9 months. It could be that it's 10 years. Who knows? We don't know. This is just the data that we have to lean on based on what has happened in the past. And so I do encourage you to think about it. So if you're finding it that it's just, you've written several offers and have not been able to get into contract and are just at a point where you're like, I'm tired. I just don't even want to keep. I'm going to wait for the market to come down and then I'll jump in. Just know that, at least, again, based on the data, you may be waiting a while. And so if that's comfortable for you, by all means. If that's not a length of time that you foresee yourself being willing to wait, talk to a professional. Would love to work with you and figure out a game plan that works best for you, just puts you into the strongest position to weather any kind of storm in the future. All right. Well, thank you so much for watching. Definitely check out Ryan's full blog post below. He has a ton of great information. And if you have any questions, again, don't wait. Reach out, and love to help you in any way that I can. All right. Thank you again. You can reach me at 916-215-4348 or via email at Eduardo, EDUARDO @thepire, PIRE team.com. Thank you so much for watching.